Hello, investors and traders, and welcome to the weekly market report. I'm AJ Monty, and this is a daily candle chart of the NASDAQ Trust, ticker symbol QQQ. It's basically the ETF that tracks the tech sector. And as you can see right here, as I magnify this, this is the diagonal line that I drew last Friday, putting out the forecast that we would go lower, with the end of the line right there being my target at 316.53. That's exactly where we wound up, and we even went a little bit lower than that. And so this is, again, one of those forecasts that worked out perfectly, and therefore the charts become a very good risk management tool for the times when we are wrong. And I want to make that a very clear point, because let's say I think the markets are going to drop, which I do believe will happen. My forecast for next week is that we're going to go lower and drop below that 20-period moving average. The main reason for that is the increase in volume. Now follow me here. If this market decides to bounce and go up from there, instead of going down like the forecast, I tell people, put your stop somewhere below that moving average. If you're trading an individual stock, then look at where the support level is, put your stop in place, and then as the market moves up, you can trail your stop. It's all about risk management. But next week, because of that increase in volume on the Qs, I do believe that we're going to go lower. And if you see the momentum indicators here, particularly in the stochastics, that is still showing downward momentum. The CCI is still showing downward momentum. And when the CCI starts getting into this oversold territory here, and if we're lucky enough to see a support level being tested, let's say down here at this level from these lows, if the CCI starts turning up and we start to see bullish candles, then of course we can take some long positions and do it conservatively with a scaled in approach. That's more along the lines of trading strategy. But that's the forecast for next week. Be careful. A lot of volatility this week. And that brings me to the VIX. The volatility index, you can see here, my lines again left on the chart from last week. We not only hit my target at 2608, but we blew through that target and blew through the resistance area right here. Now, from the looks of it, we have mixed signals on the VIX. Look, the stochastics is going up and the CCI is going down. What does that tell us? Well, I still think that the VIX could go a little bit higher, only because we have higher lows, higher highs. So technically the candles are still in an upward trend. But as soon as this indicator here, the stochastic, starts turning lower, that's when I would expect to see some kind of a bounce in the general market. Why do I say bounce when I'm talking about the VIX going higher? Because for the most part, the VIX is inversely related to the S&P. If I think the VIX is going to go higher next week early on, then the S&P will most likely drop. Once the VIX starts turning down, well, what does that mean? It might be a good short-term buy opportunity for us in the S&P. So that's the VIX right there. Going right to the S&P, because we're talking about an inverse relationship, you can see again the lines on the chart were drawn last week without any of this data. Remember, that data was not there. We didn't quite hit the target on the downside, but because of this added increase in volume right there, I think we will go further down to test this support level right there. So what is that support level? I'm going to extend that for you. That support level is going to bring us at a target right around 363.38. And we're going to be keeping an eye on the volume. Again, if the market does not go down, like I think it will, then protect your profits. You're now in a no-lose situation there. If you put your stop below this low, or even keep your stop a little bit higher and just under this low, and if it goes up, again, nothing lost. You protected your profits. Unless you're taking a short position, which a lot of people are less likely to do, especially with some of the high volatility short squeeze stocks that we've been seeing this week. But for the most part, again, protection is the best thing right now, because if you get stopped out, you're creating cash for your buying power so that you can participate at the lower levels should the markets hit those support levels. Take a look at the diamonds, ticker symbol DIA, same thing. Targets were hit. I'll zoom in there. Precisely, the targets were hit. We're at this point right here of support. I was originally thinking we're going to go and maybe bounce off of that level of support, but look at the oscillators. They're all turning lower. And so I'm going to move that support level. I think we're going to break out below that and test this support level right here on the diamonds. And that would bring us to, I'll just draw it right there and highlight the target at 293.89. 293.89. That's going to bring us about 300 points lower on the Dow. And, of course, that's something that we can see because we've seen that this week up and down. That kind of range is something that's more or less becoming commonplace. But again, protect your positions, especially the long ones. For you option traders out there, we're taking some put spreads on. We're doing very well. For those of you that are interested in our Trade Alert service, especially the option trades, every single one of the trade alerts that went out this year, we haven't taken a single loss on any of them. We came close to taking a loss on BYND and a couple of others, but every single one of our positions are working out. We haven't had to take one single loss. I challenge anyone to find that kind of a record. And keep that in mind that when we're trading options, we might have a 100% success rate on our trades, but we're not 100% on the technicals. Why? Because if you learn how to spread trade, you can actually make money on the way up and on the way down, or even if the markets just drift sideways. Just something to think about. Just planting a little seed there for those of you that want to take the time to learn options. And you can see me or any of our websites that have that information. So just putting that out, not necessarily as an infomercial, but something as a point of interest. All right, so that's the diamonds. We take a look at the IWM. That's the Russell 2000. And you can see here, hit that target precisely. This was a little bit different because I said early on in the week, as I magnified this, I said we most likely go up early in the week. We did that. And then I said we would pull back with that price target at 206.68. We hit that precisely. And again, like the other markets, I'm going to keep my eyes set on that gap fill point right there. So I think the Russell is actually going to drop just to that point. And then maybe we'll have to see if the volume drops. What I don't like to see, if you're long any positions that is in the Russell, is this increase in volume. The good news for anyone who's long is that if this gap fills down here, there's an 80% chance it'll bounce from that gap fill point. And we have a long stretch of red that I refer to as a stale red light. So we're long overdue for a green. We'll have to see if that happens either Tuesday or Wednesday. But right now, the momentum is still pointing lower. All right, so that's our market report for this week. Keep your stops in place. Make sure you're keeping your eyes on the downside to protect against any loss. Protect your profits, and you'll have a very restful night's sleep knowing that you're doing a good job managing that risk. So take care. We'll talk to you next week. So long.